China's economy just hit a wall, and it's about to change how much you pay for everything, from your mortgage to your next phone. For decades, China grew at 10% a year. Now it's around 5% and falling. That sounds like their problem, but here's the truth. This slowdown is already hitting your 401k, your paycheck, and your cost of living. In the next 10 minutes, I'll break down exactly what happened, why it matters to you in the US, and what comes next. No hype, no propaganda, just the clear picture you need to make smarter decisions. This is Both Sides of China, where we cut through the noise so you can actually understand what's going on. This is episode 1 of our China Economy Explained series. Over the next few weeks, we're breaking down the biggest questions about China's economy, one topic at a time. Today, how the miracle ended. Future episodes, the property crisis, youth unemployment, debt, and what it all means for your money and US strategy. Each video stands alone, but together they give you the complete picture. Subscribe and hit the bell so you don't miss one. The miracle years. Let's go back to the beginning. In the late 1970s, China opened up. By 2001, when it joined the World Trade Organization, it became the factory of the world. Foreign companies rushed in. Supply chains shifted. Made in China was suddenly everywhere. For 3 decades, China grew at near double-digit rates. The formula was simple. Massive government investment in infrastructure and housing, millions of workers moving to cities, and booming exports to the US and Europe. This wasn't just China's story. American companies made billions, stock markets soared, and your consumer goods stayed cheap. But no economy grows at 10% forever. The 2008 turning point. The 2008 financial crisis changed everything. While the US and Europe crashed, China hit the gas, pouring money into infrastructure, real estate, and local government projects. Growth stayed high. Cities expanded. Highways, railways, built at incredible speed. But underneath, the model was becoming more fragile. Local governments borrowed heavily, developers borrowed heavily, the financial system loaded up on risky loans. If you've ever thought China's numbers look fine, but something feels off, this is why. The system kept moving, but the cracks were forming. The property and debt hangover. Real estate became China's growth engine. For Chinese families, buying an apartment was the main way to build wealth. Developers sold units before they were even built. Local governments financed everything through land sales. Eventually, it collapsed. Authorities tried to limit developer borrowing. Sales slowed. Big developers like Evergrande ran into trouble. Projects were left unfinished. When construction stops, the entire supply chain freezes. Steel, cement, appliances, furniture, local government revenue. Now, if you're watching this from the US thinking that's China's problem, not mine, hold on. When China builds less, it imports less. That means fewer orders for global suppliers, commodity exporters, equipment makers, industrial companies, which affects corporate earnings, stock prices, and jobs far beyond China's borders. Structural headwinds. On top of property problems, China faces 2 deeper issues. First, demographics. Its population is aging fast, fewer young workers, more retirees. When your workforce shrinks, your economy naturally slows. Second, weak consumption. For years, China talked about shifting to a consumer-driven economy, like the US, but families still save heavily because of housing costs, education, and healthcare worries. That transition has stalled. Official data shows youth unemployment at 16.9%, but that excludes students and those who've stopped looking. Social media reports from Chinese cities reveal a harsher reality. So many people are looking for jobs every day. They've sold everything they can sell, except for their phones, because without a phone, how can you find a job? This desperation has fueled a pretend work industry, where unemployed youth pay $4 to $7 daily to rent office space and appear employed to their families. Companies offering fake interviews and staged workplaces have emerged in Shanghai, Shenzhen, and Hangzhou. The youth unemployment crisis isn't just about finding work, it's about finding work that pays. A recent finance graduate in Hangzhou posted this after visiting job fairs. The salaries are too low. After walking around, it's either sales, operations, or education. These are all pretty much the same, around 3,000 or 4,000 yuan. That's $400 to $550 monthly, barely covering rent in major cities. This explains why China has struggled to shift toward a consumer-driven economy. When young workers earn this little, saving dominates spending. They can't afford to be the consumers China needs them to be. The education to employment mismatch extends beyond first jobs. A parent in eastern China captured the frustration.
哎呀，
Oh, I finally managed to raise a university student, but after 4 years, she can't find a job. She's learning elderly caregiving. Yes, elderly caregiving is more lucrative. This isn't just a story about unemployment. It's a story about how China's dual crises are colliding. As the population ages rapidly, demand for elderly care rises. Meanwhile, graduates who invested years studying finance or engineering pivot to service jobs because those are the only positions available. The structural mismatch between education and opportunity is one reason youth unemployment remains stubbornly high. Here's the real question: why should you care? Let me show you 5 ways this hits home. Your retirement account. If you own index funds, you're exposed to companies selling into China: Apple, Tesla, chip makers, Starbucks. When China slows, earnings get cut. That hits your portfolio. Prices of everyday goods. China is still central to supply chains. When factories move or demand drops, costs change. Electronics, clothes, household goods, what you pay is directly tied to what's happening in China. Your job and local economy. Even if you don't work with China, someone near you does. Farms, factories, logistics, tech. When their orders drop, hiring freezes and wages stagnate. This isn't just a youth problem. China's 301 million migrant workers are aging. The average age is now 43.2 years. Middle-aged workers who once had stable careers are being forced into the gig economy.
我是86年的，今年40岁。
I was born in 1986, and I'm 40 years old this year. I've been unemployed in Tianjin for over a year, and I've been driving for ride-hailing services. At my age, finding a job is difficult. This former regional sales manager's story, losing his job at 40 after caring for a sick parent, then pivoting to ride-hailing work, reflects a broader trend. As construction employment drops to 16-year lows, millions of workers are transitioning to lower-wage service jobs. That shift ripples through global supply chains and affects demand for American exports. Interest rates and borrowing costs. Slower China lower commodity demand equals cooler inflation equals Fed policy shifts. What happens there influences your mortgage, car loan, and credit card rates. Geopolitics and taxes. Economic pressure fuels trade fights, tariffs, and defense spending. You feel that in higher prices and how your tax dollars get spent. External pressures and the new normal. Now add external pressure, trade tensions, tech restrictions, countries diversifying supply chains away from China. For China, that makes the old model, exports and investment, even harder to sustain. For the rest of the world, it means adjustment costs, new opportunities, and more volatility. So here's the bottom line. China isn't suddenly collapsing, but it is shifting from 8 to 10% growth to a new normal around 4 to 5%. That's a fundamental change in how the world's second largest economy works, and it directly affects you. You don't need to chase every headline or become a full-time China analyst. What you need is a clear understanding of the forces shaping China's economy, so you make better decisions about your work, investments, and future. If this gave you that clarity, hit like, subscribe, and turn on notifications, because this is just episode 1. In our next episode, we will explain why China has struggled for years to shift from investment-driven to consumer-driven growth, and what that means for the next decade. Each video builds on the last, so you'll walk away with a complete view of China's economy. Thanks for watching Both Sides of China. Stay calm, stay informed, and I'll see you in episode 2.